Rob. Okay, so here we are on session number 8, and we're going to continue on with our terminology and forms. This is, again, getting everybody up to speed on the verbiage that's really necessary in order for you to have success in being in this industry and understanding all the little nuances of the things you're going to run into so you can be successful. So I believe where we left off last time, you can correct me if I'm wrong, but I think we finished off on the personal financial statement. Does that sound correct?
Yeah, we're going on to K1 forms now.
Yes, perfect. Yeah, so you feel like you got everything answered last time? Or is there anything else that is looming?
I think I got a good grip on everything. I think I understand it pretty fully now.
Good, awesome. And thanks for the little tweaks on some of the corrections. Michelle and I went through that today, and I know she's going to be fixing those, so that's good. So thank you. So keep that up. Okay, so K1 form. So what the heck is a K1?
The K1 form it's prepared for like each partner of a business, and it shows the income and the losses and the dividends from the business, and it's for like their personal tax filings.
Exactly, spot on. Yeah, so the K1 distribution form is if I have a partnership and I'm 20% owner, at the end of the year when the company files its own tax return, it's going to give me a distribution, because on the LLC or partnerships, unlike a C corporation, lots of advantages, but what it does is it rolls down to the individual's personal tax level. So what'll happen is that they'll receive a K1 distribution form that will say, hey, you had a bunch of losses or you had some gains and or distributions that you took out of there. So that K1 form is really important when you're doing tax analysis, that you're always going to ask for K1s, because people will send you personal tax returns. Most of the times they won't send you K1 distribution forms. So you almost have to ask for that and say, make sure you send me all your K1s for every entity that you own, so that we can run the cash flow on that. So lenders are big time K1 distribution form people. And so that's something you'll become real familiar with when people pull money out of their companies and then when they receive that. Now, when you see the losses as well on those, a lot of times you go, gosh, they lost a bunch of money. But in actuality, they may not have. It may have just been a paper loss. Do you know what I mean when I say a paper loss?
Do you mean like a loss, like cash flow wise, but they might have like gained something elsewhere that's not like cash flow technically?
Yeah, good shot at that. So think about it this way. So let's say I made $1 million. Okay, so let's say that the gross revenue of a rental property was $1 million. Okay, and let's say that I have my normal expenses. Maybe they're, I don't know, 400,000. Okay, so technically my net income is 600 at that point, right? Now, if I am strategic in the way that I'm trying to do that, I want to minimize legally my taxable income. So if I own the property, I have the ability to write off depreciation. So that depreciation is when it'll basically allow you to use this, what I call a kind of a paper write-off, meaning that, from an accounting perspective, if you take let's say the property was 20 million bucks. Okay. So what they'll do is they'll say, well, the property you bought was $20 million and your land price on that $20 million was 2 of it. So you have a net $18 million of building. So we're going to depreciate that over a 39-year period. Okay. And so the accountant has this straight line depreciation sort of calculation to come up with. And what the theory behind it is that after 39 years or so, that this property should be fully depreciated, meaning that its usable life is gone. Okay. And so every year I'm dividing that 18 million divided by 39, and I get to take that amount and deduct it against my income. Now, in reality, it wasn't really an expense, technically. I mean, it is from an accounting perspective, but I didn't physically cut a check, right? It just was something that I get to take advantage of from the IRS to put on there to lower my tax base, okay?
Okay, so it's basically just like, you're taking that out so that you're not paying as much towards any of your taxes. And then because you've taken that out from an IRS perspective, then it's going to show that you had a loss there. But in actuality, like everything that you earned is still there. It's just how you've written it off to take advantage of that.
Correct, yes. And so sometimes the depreciation might not be enough to make it a loss, but then sometimes it might, right? So if that depreciation was, let's say if I had 600,000, let's say the depreciation was only 200,000, right? So now my net taxable income is 4, right? So I have a $400,000 tax distribution that's going to come through to me personally, right? But let's just say, for example, let's say I could accelerate the depreciation and write it all off in 1 year. And so maybe that was 700,000 I got to write off that year. And so all of a sudden I show a loss of 100,000. So once I get the K1 distribution, I'm like, gosh, Lana, you lost $100,000. And you're like, well, not technically, right? From a tax perspective, I did, right? So I'm not having to, but technically it's just a paper loss because I really made, 600,000, okay? Because I accelerated the depreciation. So those are just some things that you're going to learn as you go through this. There's even things like capitalization, meaning if I do a construction project, I can capitalize the interest. So all that interest that was paid during the life of the construction loan actually shows as a big loss, okay? Even though it's not technically a loss, it's just I'm building a project and I can take all that interest and write it off.
Mhm.
And now I have this huge loss against me. Even though, again, I wasn't cutting checks, but I was compounding or putting interest into the project that was already built into the budget. And so it's just sort of again, it's a tax thing. So I don't want to go to the weeds on that. I'm just trying to give you an idea that, when someone sees a loss on the K1, that's not
always
the
a
end of
bad
the story.
thing.
Yeah, exactly. So it's good to know. But again, K1's big deal, pretty straightforward, but you'll learn a ton about those, or you'll be using those a bunch. Okay, so certificate of good standing. What is that all about?
The certificate of good standing is basically saying that a business is up to date on paying all of its fees, has filed all of the forms that it needs to file, and done everything that it needs to do to be able to operate as a business legally.
Yeah,
And
100%.
is that, I think that's on the state level, right? I can't remember if we learned when that was higher than that, but I know that one is from the state level.
100%. Yeah, exactly. So certificate of good standing is, hey, I've got my LLC. Lana set up her LLC in Arizona State. She every year has to provide some filings to the state to be in compliance. And then they're basically saying to you or us, if we're lending you the money, that your LLC is in good standing, right? So they'll provide this certificate at a state level that will tell me, hey, her LLC is perfect, right? There's nothing wrong. She's in compliance and you're good to go. So that's pretty much what it is at the state level. Now, every state's different, meaning that, sometimes it's really easy to get it and they'll say, go download it online and it takes you 5 minutes. Some other places, not so easy, right? Like you have to jump through a bunch of red tape just to get the certificate of good standing. So, but again, just not a lot there, but you definitely need to know it because it'll come up from time to time to make sure, like, hey, is it in good standing? Sometimes they're not. Be surprised.
Yeah,
They'll
not
go,
good for a
hey,
lender
actually,
if they're
you haven't filed
not.
this. Yeah, it's just, you're like, oh gosh, I haven't filed that for 2 years. It's like, well, you're going to have to now because otherwise you're not going to get a loan. So, So those are nuances of the deal. Okay, so payoff letter, what's that all about?
The payoff letter is basically, so we can request it for the borrower from the lender to know how much it's going to cost them to pay off the rest of their loan. But I do remember that we have to make sure that we ask the borrower if it's okay to request that form and get that from the lender, because the borrower might not want the lender to know that they are going to try to pay that off yet until they have like another loan set in place.
Yeah, 100%. Yeah, it's just, it can be a little bit of a sensitive subject. If there's some tension between the lender and the borrower, a lot of times they just don't want us to do that till the end. And so we honor that. Now, personally, I like to get it as soon as possible because
Penalties or anything like that, and if it's going to be
100%.
more than you expect.
Exactly. So great job. Yeah, you're really, we want to push for that because a lot of times people have no idea they even have a prepayment penalty. I've had that happen. We get to the end and they're like, oh, oops. I'm like, yeah, oops is right. Like that's a $500,000 oops. So, you know,
Yeah.
it's something that we definitely, I try to overemphasize. If not, I say, look, I need you to go back and get a copy of the promissory note just so I make sure there's no, you know, little things there. So, so that's good. Yeah. So payoff, again, not a ton to know there, but there is those little kind of things you want to be cognizant of. Service contracts. Do you remember that? What we talked
Yeah.
about there?
The service contracts are all of the contracts that an entity has with a third party or any third party vendors. So like pest control or landscaping, or like if they got like termite inspections done or anything like that. And we collect all of those so that we can give them to the lender. And we have to make sure that we have all the signatures and all of the forms as complete as thorough like as they are, to give to the lender, just so they know like what has been done. And is it kind of like to make sure that it shows that they've been like keeping up with the property, or like keeping up with all those things to make sure they're not going to be like negligent, kind of like a risk management sort of call.
Great question. Yes, that is definitely one of the reasons for sure. They want to make sure like, hey, you haven't been negligent, you've been keeping the property clean, you've been spraying for termites. So yes, 100%. That is a comfort, right, for them as well. The other thing they want to try to do alongside that is to say, you know, what is this really operating at? Meaning like, you're telling me it costs X to operate, but is that really what it is? I want to see your contracts, you know. I mean, usually when people buy smaller apartments, the biggest issue they have is they think, oh, I can operate this property for 25% of the expense ratio. And my response is, no, you can't. I said, you know, you try like 40, you know.
In a perfect
it's
world.
Yeah, I said, if this was like brand new property and no issues, maybe,
For a
but
few years.
yeah, exactly. Yeah, in Lululand, you might be able to kind of to do that. But yeah, so we always try to, so a lot of it is confirmation to kind of go like, okay, what's really been done? And like you said as well, it's like, hey, if you've been neglecting the property, then I'm going to get stuck with like cleaning up all this stuff. I mean, I remember buying an apartment and I went in there and literally there was 1,000 German cockroaches. So if you can kind of
Oh my
imagine
goodness.
how disgusting that was.
You're like, yep, I'm just gonna go.
Sayonara. Yeah. So yeah, it's lots of things can go on if people neglect it, for sure. Okay, so UCC filing. Do you remember what that meant?
So from what I understand, it's basically like a lender saying that they have the right to seek like any sort of like personal property, or like go after them personally if they do not, if the loan defaults. But there was also a portion saying that they have to like put that out in like the news or something, not the news, like the newspaper, and make it kind of like a public announcement that that is something that that lender is going to do.
Yeah, it's generally through the Secretary of State. You can kind of find out if like a company has what's called UCC filings on there. It's uniform commercial code, and basically, okay, so if I go lend against a piece of real estate, okay, I'm going to file a deed of trust against your property. Okay, so that allows me to have a security instrument against your real estate. So if all of a sudden Lana's paying on time but runs on tough times, can't pay, then I have the right to go in and say, okay, well, make me whole. But if you don't, I have the right to foreclose on the property. Okay. So it gives me a security instrument so that I am assured that if something happens, if you can't pay anymore, I can step in and take over and obviously liquidate the assets, right? So on the UCC filing side, that's almost tantamount to me filing a deed of trust against the business, okay? So now I'm filing it against those business assets like furniture, fixtures, equipment, things like that. And so I have the right now, and I'm in first position if I have a UCC filing, I am in a position to come in and say, well, if you default on your business and you can't make this loan anymore, then I could technically, I might not, but I could technically come in and start liquidating things on that business. That's essentially what I'm saying.
Would they have to put specifically on that filing, like I could take like this furniture and this asset that's on the property, or like this portion of the property or something like that? Like, do they have to put specifically like each thing that they could take, I guess?
It's a great question. It depends. So if you're dealing an SBA loan for a borrower, then what will happen is they will make you fill out a document that says if there's anything that is $5,000 or more, they want you to line item it. Okay. So if it's like a restaurant, they want to know like anything you think is worth 5,000 or more, we want it line itemed on this document. Okay. So they're literally like solidifying the fact that we know that all this stuff is there. And if we have to foreclose, we know that this is what we're going to liquidate. Now, I will tell you, most lenders don't do that, just the SBA, because there's so many little red tape nuances to it. But most lenders will just file a blanket, what they call a blanket UCC filing. So it's pretty much saying, hey, anything you've got in there today or in the future, we got rights to go after that, essentially. Yeah. So it's a good question. Now, if someone's malicious and they're the business owner, they could start ripping things out before they take off. So that is the risk. That's why real estate is much more secure, because you're not going to lift that up and take it somewhere unless you have some.
Yeah. A little bit
very difficult. Yes. Yeah. The UCC filing again is it's something that we try to find out earlier than later, because if all of a sudden the lender says, hey, we're going to have to file a UCC, well, someone might already have one on there, and the lender might go, hey, if you already have a UCC, so I'm not coming in second position behind the UCC, so you better take that out or else we're not going to be able to do the deal. I've had deals blow up because of that. So it's something that we do in advance, as we really try to say, hey, look, do you have any UCC filings now? And again, if they say no, we still probably do some searching just to make sure. Just because sometimes they don't even know what that means.
Yeah. Or they've forgotten, or some people just don't want to tell everything too early.
100%. Yeah, people definitely, we have to double and triple check things because they're not always upfront. Okay, sponsorship. Do you remember what we mean when we say sponsorship?
Basically just another way of saying like a borrower or a guarantor.
100%. Yeah, not a whole lot there. It's just, again, language. You're kind of like, you're going to hear people say, hey, who's the sponsor? And so now you'll go, yeah, that's the person that's borrowing the money. So, okay, par. Tell me what you remember about par.
So par is like equality, or like at the normal rate. So if like lending terms, if someone says, oh, well, this is at par, then they don't have anything like origination fees or anything like that. But it could work out to be not in favor of the borrower because the lender could be increasing the interest rate to make the value of the loan come down to par. And then over the life of the loan, they would end up paying much more than they would have if they had just had the higher rate or the higher value in the beginning.
Yeah, no, spot on. Yeah, great job. So yeah, par is kind of like if you ever played golf, right? You say, is that par, right? It's like, well, is that that would be the normative, right? So it's like, okay, well, you're going to have to hit this hole and make it in 4 strokes. And if anything over than that is not par, you know, if you get lower, you got a birdie or you got a bogey, right? So it's so par is kind of like equilibrium. And so that means, yeah, we're not charging any fees, right? That's par. But like you said, somebody could be saying, well, that's great, but in actuality, maybe it's not, because what they're saying is if you would have paid the origination up front, as opposed to having par, you probably would have paid less over the life of the loan, okay? Because what happens is, and you're going to learn about this one if you already haven't yet, is yield spread premium, right? Where basically the lender essentially says, well, we're going to sort of jack up the rate and then we'll pay you this fee on the backside. And the borrower is going to pay a lot more in their interest rate over a longer period of time. So they might pay like 3 or 4 or 5 points.
Yeah, and that's when like a broker gets maybe like a little extra on the side or whatever for doing
Yep.
the yield spread premium, and it's also like the referral fee, I think, right?
Yes.
Okay.
Yeah, spot on. So it's a big distinguishing factor for our firm personally.
We don't do that.
I would tell you 95% of the groups don't do that. Okay. The reason we do it is because, you know, I sort of am like, well, it just doesn't seem like I'm really acting in your best interest if I'm trying to jack your interest rate up so that I can make more money. You don't know anything about it, and you just got stuck with this interest rate for a long time. It's just something about that just doesn't feel right. And so we've just decided. Now, there are lenders who will say to us, look, we'll pay you a referral fee, but we're not going to charge any more to the client for that. Well, we're fine with that. If they choose to take that out of their own account to pay us, we're fine.
Mhm.
But we just don't like the concept of like, I'm going to make more money. And
Yeah,
I
and
know
basically
about this.
charging them more than what was originally agreed upon, just like without them knowing that.
100%. It's just that there's no transparency, and it just kind of feels like I'm not really acting in your best interest. I'm just trying to make as much money as I can on you. Again, we all have to make money. It's okay, but I just would rather be really upfront and say, look, this is what we're charging, it's how much we're making, and everybody's kind of able to make those choices themselves, right? And so that's sort of our philosophy. It's just another way that we can kind of, sort of have that servant attitude for the client, so we're aligned with them. And so that's a question we always ask. I make my associates always ask that question all the time. I'm like, because they're like, we're going to pay us a referral fee. And I said, okay, did you ask the question? Are they jacking the rate up in order to do that? Right. That's really important, because if they are, then no, we're not going to take it. And so sometimes, that's a tougher discussion, but we have to do it if we're going to be in line. So par, you're going to hear that a bunch. So it'll be something you'll just kind of know now. Okay, par means, that they're not charging the origination fee. Okay, so good job. Okay, secondary source of repayment. So this is kind of rewinding a little bit to what we talked about TAD last time. But what's a secondary source of repayment?
So basically, the secondary source of repayment is like a backup payment. So if the first source of repayment was going to be just like operations done in the entity, then if that were to fail, then where would they go next? So like if they would go to that guarantor's personal finances, or if there's like some sort of savings that it would come from, or just anything else that can be used as collateral, just so that the risk is being mitigated.
Yeah, great job. Um, yes. So like, if I'm the banker, I put my write-up together, I'm going into committee to present the deal. Most of the times they're going to say, look, what's the secondary source of repayment, right? And if they don't have the answer for that, they're in big trouble. And so to your point, they're always saying, is it cash flow from the personal side of the coin? Is it cash? And the final one usually is they say the final resource of repayment is liquidation, right? Kind of like we just talked about for the real estate. And so they'll say, if we're going to liquidate the asset, that's the final and last resort of repayment for the loan. We don't want to do that, but it is certainly a source of repayment at the end of the day. So good job. So you'll hear that from time to time from the lender side of the coin. So good job. So discounted payoff, what's that all about?
Basically, when the current loan, or when the lender who has the loan, like right then or at that time, is willing to take off like a discount from the face value of it.
Yeah, exactly. So the only time you'll really see that is if somebody is in a weird situation where they could be in default with the current lender. They've been trying to work through it for a while, and so it's a little exhausting for the current lender. And the lender is kind of like, hey, we just want to get this loan off the books.
Mhm.
So if that means we have to take a discount, that's fine, you know. And so we'll take a little bit of what they call a haircut, or sort of chopping. So if it would have been $1 million, they might have said, hey, we'll take 950. We don't care, just get it out of here, right? And so sometimes you'll see that just because somebody got into a little bit of a pickle, and so we're taking it out. Sometimes as if the market, the economy has gotten softer, and lender just has to clean up their books, especially for banks. The bank's regulated and audited by the FDIC. So a lot of times they'll come and say, hey, look, you need to get this off the books. Well, that's a big red flag, because if the FDIC is asking to get it off the books, then they need to do it fast. Otherwise, they'll start getting
Yeah.
penalized. Yeah. So good job. Okay, C&I loan. What was that?
Those are commercial and industrial loans that are they're like not real estate related, and banks will usually do those kinds of loans when they're trying to build relationships while they're doing business.
Great job. Super smart. Like these are equipment loans. They could be lines of credit for the business. So yeah, so you're just going to hear like, hey, we really focus on C&I loans. What they're basically saying is these are business loans that we like to give for accounts receivable or equipment or lines of credit. That's basically what it means. So you'll kind of know, okay, that's what that means when they're talking about it. Legal lending limit.
So a bank will have like a legal lending limit, which is basically how much they're able, how much they're able to give to one person at a time, and how much they're able to lend to them at once. And then the bank itself can also have a limit that's like their institutional lending limit, and that can be, I mean, it'd obviously be a much greater number, but it's basically how much they can lend all at once.
Absolutely. Great job. Yes. Yeah. It's the FDIC will typically set a cap of what they can lend to the borrower. Why do you think they do that? Why do you think they would set a lending limit?
I feel like it's partially because they don't want to take a lot of risk, and so it's kind of like putting all your eggs in one basket. You might trust
Yep.
this person as much as anybody, but it's once you put all of that money towards them, it could go south, and then things happen, and you don't end up getting paid. So if you're kind of dispersing who all has the money and how much you're putting towards each person, then you're not taking as much risk on one.
100%. Yeah, exactly. It's just this eggs in the basket thing, right? So you told me, you said, Dave, I took all my life savings and I threw it in the stock. I'd be like, well, we might want to
Like what?
diversify that a little bit. So it's just, that's the thing. It's like, well, this is a great borrower and I have half my portfolio with him. It's kind of like, I don't know if that's a good idea, because if he goes up, belly up, then you're in big trouble. And the lenders always look at that too, like even on the revenue source, they'll basically say, does your revenue come from like lots of different clients or like a few, right? Because
Yeah.
if it's a few, then they're like, well, gosh, if you have a third with one client, if they go bankrupt, like that's a big problem. So, so it's basically risk. So great job. And what, just on that note, kind of a little asterisk to it. A lot of times lenders will say, hey, that's above our legal lending limit, but we can participate the rest of it out. So what that means is they'll actually partner with another bank. Sometimes they'll have a parent bank as well. And they'll say, well, I can do, if it's a $10 million loan, they might say, hey, we can do half of it. And then we're going to get another bank to do the other half. And then it's a little bit seamless to the borrower because they're behind the scenes, but they'll virtually kind of absorb most of it. So, and we'll kind of learn about that as we go along. Rate lock agreement.
So that is when a lender is providing an option to lock the interest rate through the trading bond market. And whenever that's done, there is no going back at all. So it's really important that the borrower is like on the phone with the person who's going to do it. They completely understand every single part of it, because once it's done, there's nothing that can be done to undo it.
Exactly. Yeah, rate lock agreements are really interesting. In fact, right now they're almost completely exempt, meaning they're just not doing them. The interest rate environment is so volatile right now that lenders are kind of like, hey, we're not locking anything up front because we could have locked at 5 and now interest rates are now like 6. So we're just not going to do it because we're losing money at that point.
Mhm.
And so, you're not going to see a ton of it, especially right now, but we've done it before and borrowers like it because it gives them an assurance that, what they started with, they're going to finish with at the end of the origination process, essentially. So, typically with CMBS loans, you're going to see something to the tune of like a rate lock desk. So you'll actually get on the phone with the trader. The trader will literally tell you, here's the rate right now. Do you want to lock? Right. And the borrower has to be on there and says yes or no. And so it's a little risque. I always tell the borrowers, they're like, hey, I want to lock the rate up front. And what do you think is going to happen? Should I kind of play the Las Vegas here and roll the dice?
Yeah, it's a gamble either way.
Like, no. I said, I have no idea what's going to happen. I'm never going to pretend I know what's going to happen. It's just, it's out of my hands.
Yeah, like it could work out great, but it could also work out horribly, horribly wrong. Like right now, if you could lock an interest rate, it would be probably great for the borrower because it's showing that we're just going up and up and up right now. But the second that there's a change in that, the drop that they would see and the amounts that they would be paying more than anything else would be pretty upsetting on their end.
Exactly. 100%. Okay. So what is an interest rate index?
So I'm a little bit confused on it, but it's an index based on the interest rate of a financial instrument or like a group of financial instruments. And it basically sets like the benchmark for how much a lender can charge on a mortgage. But I don't think I really understand like what the instrument is that we're talking about.
Sure. Yeah. Great question. It's a little tricky. So, if I'm lending you money, the question always is, how do you determine your rate? You know what I mean? Like how did you come up with that? Right. And so they've created all these indexes. Okay. So it's kind of the way that they determine how they're going to price loans. So an index is just something to the tune of like an industry standard or a type of index that I'm going to use that represents the majority of the market. Okay, so one of the indexes that a lot of lenders use on the bank side is Prime. So Wall Street Journal Prime. Well, prime is basically what you keep seeing going up when the, federal government and the Treasury Department comes out and says, hey, we're jacking the rate up, 75 basis points, right? And so that's the rate at which lenders will receive money at a cost. So then they're going to have to turn around and charge a spread on top of the index, because the index is almost like saying, well, that's the cost to me, okay, just to operate. Okay. So that index does nothing more than just covers my costs. I'm not making any money. But because I'm in the business of making money, then I have to put a spread on top of that index in order to get an all-in interest rate. Okay. So that I have my index, which basically, if you just, another way to think about it is, it's just my cost of doing business on a interest rate level. And then I'm going to charge a spread on top of that, which would be like 200 over that. So if my index was 475 or 4.75, and I said I'm going to do 2 over the 4.75, then my all-in interest rate is 6.75%. Does that make sense?
Yeah, I think so.
Yeah. So there's the types of indexes you'll hear are like SOFR, Prime, FHLB, LIBOR used to be one that's kind of gone away, which is the London International Bureau of Rates, so it's an index has kind of gone away. So
yeah, I did
is
see that term and I was like, I don't know what that term means. So
yeah, no, it's so LIBOR kind of went away and SOFR like replaced it. And SOFR, just to give you an idea, is basically the secured overnight financing rate. Okay, so this is the broad brush borrowing rate of overnight treasuries that the institution will lend to banks. Okay, so they just kind of use this index. And so banks, now a lot of times a bank might say, look, we're just going to calculate our own cost of funds. Like, and you go, well, what does that even mean? Well, because I'm kind of a nerd, I went through and tried to figure out what is the unit price, the cost per unit for us, okay, per loan. So I tried to figure out like all my employee staff and, rent expense and all these different expenses that we have. I wanted to unitize that down to like an individual loan level to figure out like, well, what does it cost me at the company level to really do a loan?
Yeah.
Because if it costs me X and I keep doing loans this size and I'm only getting this, I'm losing money every time I'm doing a deal, right? And so for us, it's about $7,500 per loan. Okay, so I know that that's my cost. So I always tell my guys, I'm like, you can't charge anything less than that because we're not making any money,
Yeah.
So it's kind of the same thing in the bank. They're just doing it on an interest rate level. So they're just saying, look, our cost per unit or per dollar, so to speak, is, $1.50. So it's $1.50, so to speak, per unit. So
Okay.
we're going to have to add that as profit on top of it. Does that make sense?
I think that makes sense. Yeah.
Okay, good. All right, awesome. Okay, so yield spread premium, we kind of talked about that a little bit. Do you want me to go into that further?
Yeah, I mean, it makes sense to me. Just kind of saying, it's basically just something that a broker is getting like from a lender, kind of like quote unquote, because it could be just coming out of what the borrower is paying, and if it's coming out of what the borrower is paying, then we don't want that. But if it's coming out of like the actual lender, then that's totally fine.
Yeah, 100%. Yeah, because they do it in these kind of almost like quarter increments. They're saying, I'll increase the rate a quarter and I'll pay you a point. I do it 50 basis points, it's 2 points, right? So a lot of brokers in the industry, I don't agree with it, but they do it all the time, is they'll try to maximize that, right? Well, I want to make 10 points. It's like,
Yeah.
okay, starting to move into a little bit of greed. But so, just we have just decided to stay away from it. So, okay, swap rate. If you kind of remember, swap rate is, do you remember what that was?
It's another type of index that a lender will use to price like the final interest rate of a loan. I know that it's like the fixed leg of the swap. It's determined by the market, and it can be determined by all of the things that you were saying before, like the Fed funds rate and the LIBOR rate.
Yeah, exactly. Yeah, it's not a whole lot you need to get into unless you were becoming like a day trader and getting into swap stuff. It's just know that it's an index. You'll probably run into from time to time. Someone will say, we're going to do the swaps plus. And again, it's just an index that you need to just be familiar with. Yield maintenance and defeasance, step down prepay. So remember this one. This one's a fun one.
Yeah, it's so it's one of the prepayment penalties, and it's like described as a make whole provision, and it's like you can take so they'll take like the original rate that they had, and then whatever the treasury rate is at the time, and I think they subtract the treasury rate from the original rate, and then whatever's left will be like the percent that you're still responsible for on the loan. I think that's right.
Yeah, no, you're really understanding a heck of a lot more than most people are. So good job. Yeah, I mean, it's essentially what you said is the best way to visualize it is it's a make whole provision. Okay. So the lender is saying, I want to be made whole on exactly the amount of interest I would have made for the whole period of time. So if I lent you money for 10 years, Lana, I would want to make all that interest for the whole 10 years. Okay. So then you say, okay, great. What does that mean? Well, it means in 5 years, if your rate that I lent you was 4%, okay, and then all of a sudden, 5 years, you call me up and say, Dave, someone just offered me like 3 times the amount of my property and I'm going to sell it, and I'm like, great, congrats. And so you owe, I don't know, call it $2 million. Okay. And so you paid this thing down to $2 million. You got 5 years left on your loan. Your original interest rate was 4%. Okay. So then I'm going to go out as the lender and say, well, I wanted to be made whole. I need to make as much as I would have made for the rest of the 5 years. Okay. So I say, well, the treasuries, Lana, are like 3%. So 5-year treasury, which is what I'm looking at because there's 5 years left, the 5-year treasury is 3%. Your interest rate that I'm getting is 4%. So we got a 1% difference. I'm losing 1% every year if you pay me off. Okay. Mm-hmm. So you're like, okay, what are we going to do? And I say, well, this is how it's going to work.
Pay me the 1%.
You're going to pay me the 1%,
yeah.
Multiplied by 5 years. Okay.
Yeah.
So you're going to take the $2 million, that's 20,000 multiplied by 5. And now you're going to cut me a check for $100,000 when we pay it off. Right. So it's kind of, yeah. So there's just sort of this differential going on. It's a lot more complicated calculation. That's basically what it is though. Just so you could, the reason why you're going to want to understand that is because you're going to have to explain it to people.
Yeah.
And because they're going to be like, what the heck is that? And I'm going to tell you something. I explain this 3 times. Okay. And the reason I do it is because the first time somebody hears it, a borrower, they're just like, oh, okay. But they don't really understand.
Yeah, so in one ear and out the other.
You just kind of go like, okay, whatever. I'm sure it'll be fine. I explained it a second time to them just to kind of go, and then they start to go, okay, what does that mean? And I explained it a third time. So they finally go, oh, wow. So that could be really expensive. And I'm like, yeah. Yes.
You're like, that's what I was saying.
That's exactly what I was trying to tell you. And so they will finally kind of, because I really want them to know, because I'm like, look, if you do this loan, I go, you're going to want to kill me if you come back and didn't understand, because you're going to go, oh my gosh, this is nuts, right? So I call it in it to win it. I said, if you're in this deal, you're in it to win it. Like,
Yeah,
it's
you're not leaving, and it's not going to
not
be good
leaving.
if you
Yeah,
do.
100%. Now, yield maintenance defeasance, they're pretty much the same thing. But they're the most complicated. And then you get into step down, which is just kind of, remember, it's like
Every
you know,
year, it's like the one less. So, like, if you had it for 5 years, then the first year it's 5% on it, second year 4, third 3, and so on and so forth.
spot on. Yeah, good job. And we made a bunch of videos, and they're kind of, I think I don't even know if it was on there, but there's like kind of a cartoonish video about it. So
Yeah, it helped.
good. Yeah. So that's actually what I tell them. I go, when my associates come in, I go, just give them the video, and then you can kind of follow up and explain. So
Yeah.
makes it a little easier. Okay, capital stack. Do you remember what a capital stack is?
So I think it's basically talking about like the purchase price of the real estate in reference to how much of it's being financed versus how much is being paid out of the borrower's pocket or like the guarantor's pocket. Also, I was going to ask, so I know that we said, or at some point in the terminology, I don't know if we're there yet, but we talk about like guarantor versus borrower because like the entity is the borrower and then the person would be the guarantor. So do we like refer to them just like in everyday basis as a borrower though, and then on like paper they're a guarantor, or do we say like guarantor in general to refer to the person and borrower?
Yeah, it's a great question. So it can be a little tricky sometimes. So the borrower is technically, I mean, if I'm getting technical, technically speaking, the borrower is whoever is the person literally borrowing the money. Okay.
Mhm.
So let's say that I lent you the money to Lana, and I was lending it to you personally. Well, you'd really be the borrower. Okay.
Yes.
Now, in this particular case, what you're going to see is most things you'll see is the borrower technically, and I would say 95% of the transactions is the entity. Okay, so the LLC is really the person or entity borrowing the money. Okay, so that's why I'm lending the money to, but the guarantor
Is the person
is
behind
the
the entity.
100%. It's the person, but here's what's interesting too. It's also probably, chances are most of the time, is the entity is also going to be the guarantor. So the borrower is the entity, but it's also going to be guaranteeing the loan as well. Plus the individual is also going to guarantee the loan, right? So they're kind of covering all their bases, because people are crafty, and so what happens sometimes is people will be like, well, it was just to me, but then they siphoned all the money into a separate LLC. So if there was ever a default, they're like, well, you only have me as the guarantor and all the money's over here.
Yeah.
So they kind of have decided, like, we're just going to make everybody guarantee in most instances. But it is important to understand the distinguishing of those, because sometimes you might have a corporate guarantee from the entity, but no personal guarantee. Okay, that can happen. Now they'll be the signer, right, for the LLC, because you have to have a physical person, but they may not be guaranteeing the loan. And so it's important to kind of distinguish that when you're trying to, and this is mostly on the lender level, is you're trying to figure out like who's the borrower and then who's the guarantor. And a lot of times, if it's really complicated, there could be like 5 or 6 or 7 guarantors.
So it would be like, if company XYZ is asking for a loan, and then say like Bob is the person who works with the LLC, and he's the one like talking about the loan. So company XYZ is going to be the one that is listed as like the borrower, and then
Mhm.
it will also be listed as the guarantor as well as Bob. They're both going to. Okay. Okay. That makes sense.
Exactly. Yep. Yeah, great question. And sometimes, and I don't want to confuse you too much, but like sometimes if you have like 5 borrowers, technically like individuals, right? Sometimes they'll say, hey, look, we're going to have you guarantee, but you only have to guarantee your pro rata share. So if, let's say, you and I were borrowing the money and there's 2 of us, they might say, well, Lana, you're stuck with 50% guarantee, and Dave, you're stuck with the other 50%, right? So
Okay.
it's not, you don't have to take the whole thing, but you're responsible for your portion. So there's nuances, but I would say in general, just understanding the kind of distinctions between that will be helpful for sure.
Yeah.
So
I'm glad I asked because that makes a lot more sense now.
yeah, great question. So really good question, because yeah, in capital stack, you pretty much explained it, but you know, if someone's purchasing something for like $2 million, then the capital stack is just that $2 million. And then the question is, well, how does that get financed? You paying 2 million cash, 50% debt, 50% equity. You're just trying to figure out what the capital stack is. So yeah, good job. Let's do one more, and then I've got to scramble because I've got to get onto interview with some potential new interns for next semester. So that'll be kind of fun and exciting. So mezzanine financing, this one's can be a little tricky.
So I know it's like debt and equity, like a hybrid of debt and equity for financing. And then if the loan were ever to default, then it would give them the option to kind of convert to the equity after the senior leaders and the venture capital companies like have been paid out. Yeah, I think I know it has like the embedded equity instruments, and they're known as like the warrants, but I'm not exactly sure what that means.
Yeah.
I wrote it down and somewhat understand, but I just don't know what the bits inside of the definition mean.
Yeah, no, it's good. And we may, well, this might be a to be continued because it is a little nuanced, but here's the starting place. So mezzanine really is like, if you go into a building, you'll hear sometimes people say, well, there's a mezzanine level. What it means is just it's the second level, right? You go into industrial buildings, sometimes they'll have a mezzanine level. So just always think in second. So when you hear mezzanine, just think second. So somebody's coming in behind, okay? Now it's not a physical second deed of trust, okay? So someone's not filing it. Like if you go look at the county recorder, you'll see a first, and if someone physically files a second deed of trust, that would be a first and a second, okay? Mezzanine people don't do that. They'll basically say, we're going to file a lien, kind of like UCC filing, but we're doing it against the entity, okay? So that LLC you and I set up, they're going to file a lien against that, and they're going to have what's called an intercreditor agreement between the lender and them, the guy that's lending the most of the money. They'll come in and say, look, here's the agreement, Mr. Lender. I'm going to put a mezzanine loan against the entity, but here's how this is going to work. If you foreclose, okay, I want us to have an agreement that I have the right to step in and cure the default, okay? So basically the way my agreement works with the borrower is if the borrower defaults, I can step in and actually be the one who cures it and takes over the entity. And now I'm the one who has to borrow the money,
Okay.
and then I can figure this out.
Okay.
Does that make sense?
Yeah, that makes sense.
Yeah. So, and this will be a to be continued conversation.
Yeah, that's fine.
Because
I want to let you know, my phone is like water damaged, so I'm not really sure if it's like able to take calls.